Well, it doesn't seem like there was an initial flood in. Oh, I see some people coming in now. We will get started in just a minute. It's not quite 11.
Okay, we're going to get started. Good morning, everyone. Thank you for joining us on a Friday. We appreciate everyone's time. We're going to jump right into the material in a moment, but I just wanted to give a little bit of a background explanation. I'm Jacki, and I'm going to give you my introduction in a moment. And my coworker, Kali, and I have a team practice working with clients during divorce and post-divorce. And the reason we created this session is that part of the reason is that I'm a worrier by nature. And I always feel like after I work with clients throughout their divorce and we've gotten them the best settlement that we can, I always worry about what's going to happen after when, a lot of times some of the most important decisions that are facing clients happen after the divorce is done, but everyone is really tired of thinking about the divorce at that point and wants to just, shut the door on everything and move on with their life. So it does take about a year, we find, that until people are really settled into their new life, until they're ready to start thinking about their financial future. And so we decided to create this seminar with those people in mind so that we could provide some education and information that would be helpful. Just to give you a little bit of background, let's see if I can. Did the slide move, Kelly?
No, it didn't. Here.
Not move. There we go. Okay, so this is just the introduction for Kali and I. I'm Jacki Roessler, for those of you that I have not worked with during your divorce. I'm a certified divorce financial analyst, and I've been a CDFA for about 25 years. So I'm a financial advisor, but I only work with clients that are in the process of divorce. And I've been doing it again for a very long time. I love what I do. I'm also currently on the IDFA Board of Advisors. The IDFA is the national organization that certifies financial advisors in certified divorce financial planning.
Hi, everyone. I am Kali Hassinger. I'm a certified financial planner and, like Jacki, also a certified divorce financial analyst. I've been in finance my entire career, but have found that I really enjoy and have the most passion behind educating clients. And Jacki works, mid-divorce. I specialize in post-divorce planning. So making sure that clients still have someone working in their best interests after the divorce is finalized. And that's really, what Jacki and I both care about the most, making sure that our clients feel financially secure and feel that they have a team working for them. Most of you attending today are at a pivotal point. Hopefully your divorce, the dust has settled for the most part, and it's a great time to take a step back and assess your new circumstances. So if things don't feel quite organized completely just yet, that's probably why you're joining us today. Sorry, I don't know why that switched off my camera, but our goal today is to provide some tips to help you reset, hit that reset button, regain control. Maybe it's just tying up a few loose ends. And then after that, we'll have some time to answer your questions. So many of the things that we're talking about today are really unique to each individual. And we're going to do our best to share some general thoughts and tips, but we also want to give you some time to ask us questions. And ultimately, we have two goals today, and that is to educate you and to motivate you, because we believe that if you feel educated, you're going to be motivated to finally make those decisions that you're facing, those financial decisions.
Just a few housekeeping items. If you can hold all of your questions, we have a Q&A function. It's at the bottom of your screen, and if you click on that, you can enter any questions that you like. We will be answering those questions at the end of the session. We want to make sure we get through all the material that we put together, but we will be answering questions at the end. And we will also be able to, if you want to ask a question live, we'll be able to unmute you at that point. So we are going to get started.
Thank you, Jackie, yes, for that reminder.
Hey, Kali, are you able to move it to the next screen? I'm
so sorry for this. There we go.
That's all right.
These tech issues.
Two cooks in the kitchen. We're both controlling the screens. So for those of you that work with me during your divorce, you probably know that one of my most important tips for clients when they're going through a divorce is always that awful B word. Nobody likes the B word. The B word is budget, but I like to call it a spending plan instead of a budget, because nobody likes to discuss budgets. However, to me, it's the key when you were going through your divorce. It's the key to making sure that you're going to get the right settlement and that you have clarity about the settlement you're getting. Because if you don't know what you spend on a monthly basis, it's really difficult to evaluate whether or not you're going to have enough coming in. So now that your divorce is over and you have had a good year, some of you on the call have had a couple years of experience under their belt, it's a good time to start taking stock of your cash flow situation, or you're revisiting that B word. For those of you that did work with me, I still have your old budgets. If you want to reach out to me, I'm happy to send them to you so that you can, if you misplaced them or lost them, I highly recommend that you take those out and take a look and see where you're at right now. Because whatever you thought you were going to be spending, I guarantee you there's going to be some things on there that are different. It's a little bit more challenging in this past year for those of you that got divorced in the middle of or right before the pandemic, because your cash flow is probably radically different the past year than it will be in the future. So hopefully you've been able to save a little bit more without, with the restrictions about where you're able to go. For some of you, there might have been adjustments in your child support or spousal support based on your whether you were the one paying it or the one receiving it. There might have been some adjustments based on the income of the higher wage earner. A key question to ask yourself: are you short every month, or have you been able to save? And if you've been able to save, that's great. The next step for you to think is where should you be directing those savings? Does it need to help you out for over the next years? Is there going to be a gap at some point? So for a lot of us, and I was the same, when my divorce was first done, all I could think about was getting my kids settled, getting our new life settled, and making sure that we had enough money coming in to pay the bills every month, and just kind of putting my head down and getting the work done to get everybody back in a good place. What I didn't think about was whether or not there would be some adjustments down the line when child support stops. If I'm the payer of child support, when I have extra income coming in at that point, have I thought about how I'm going to plan for that? If I'm the one receiving spousal support or child support, is there going to be a reduction? And when is that going to happen? And another really important point for anyone post-divorce, whether it's 1 year, 2 year, 3 year, 4 year, I highly recommend that you take out that divorce decree and your settlement agreement if you have one, and look at it again. And the things that if you go through there and make sure that you're looking for things like the dates. When does the child support change? When is the spousal support going away? If we're supposed to be doing some sort of reconciliation of income, how is that to be calculated? All of those tiny details that at the time seem just overwhelming to think about, now is a good time for you to take out that document. I know it's not fun to think about reviewing your divorce decree, but it's a really important step for you to make sure that every loose end has also been taken care of. The only one that really is going to care about your divorce settlement being really done is you. The attorneys, after you're done, no matter how good of an attorney you had, they're probably putting your file in their cabinet and they're not going to think about it again. The onus is on you to make sure that everything is done correctly and that all of the numbers are accounted for correctly. So you want to, jot down on a piece of paper, what are some of the changes that are going to be occurring that you need to prepare for? Child support reduction, spousal support reduction. Was there a point in time where you had been planning that you would have a higher earned income, maybe when spousal support stops? And what have you done about that to this point? If you haven't, that's okay. But now is a good time to start thinking about how you're going to increase your income if you need to. For many of you, you might be coming to a point where you're eligible to start taking pension income. Again, if you have a QDRO in place, and I'm going to talk about QDROs in a little bit, but if you have a QDRO in place, that is on you to make sure it's implemented correctly. So the plan administrator is not going to contact you and say, hey, it's about time for you to make a decision to take your pension. How do you want to take it? That's going to be on you. And that's why it's so important that you pull out those old documents that you have, whether it's QDROs, settlement agreements, even your old budget. For those of you that worked with me during your divorce, we ran financial projections that showed what you would look like in 5 years, 10 years, 20 years, 30 years down the line. It would be good for you to look at those again to see how are you matching up right now in terms of your net worth and your assets. And as far as whether or not those are things that you're on track for, or that maybe you're falling behind, or maybe you're ahead. Maybe you have more money saved, which is great. And so maybe you can afford to wait to go back into the workforce. Those are all things that now is a really good time for you to revisit. I would encourage everyone on this call, when you're done, take out a piece of paper and write down what is your most important financial goal for the next 5 years, whether that's getting back into the workforce, whether it is downsizing your house, whether it's just preparing for changes in your income stream. But what is the most financial goal? Sometimes we don't even stop to think about. We're so busy in the midst of just running our day that we don't think about, again, planning for the future. For a lot of clients that I worked with, and for many of you on the call that I didn't work with, the house was a major point in your settlement. Whether or not you ended up buying a new home or renting temporarily until you could decide what you wanted to buy, or if you kept your the house that you had before and you were thinking about it as a transition point, now is a great time for you to stop and consider what is the real cost to you of maintaining the house. So for many people, me included, when I got divorced, I was concerned about stability for my children. So the most stable to me was for us to remain in the house that we'd been in. That meant a larger mortgage. That meant larger property taxes, greater cost to upkeep and maintain. But to me, that was worth it at the time to keep our stability. Another really important thing to keep in mind for many of you, you wouldn't have qualified to refinance that mortgage into a lower rate and to a lower payment Once you have 6 months under your belt, Fannie Mae wants to see you have 6 months of earned income that you can show, whether it's child support, spousal support, that counts. But you have to have it running for at least 6 months before you can qualify to refinance. So interest rates are very low. Now would be a good time to consider whether or not you should refinance or if you should consider downsizing. But this is a good time for you to start thinking about that decision. Another important thing for you to keep in mind, have some of the emotional reasons to keep that house changed. I know that for me, a couple years after my divorce, I recognized that the stability that we had between my ex-spouse and I for our kids, that was more important than probably staying in the house. That the house is for many people, it's a lot to manage for one person. Now that you've got a year or so under your belt of taking care of it, whether it be the landscaping, outdoor needs, everything, things break all the time in the house. The house is a major expense, and you really want to be thinking about how maintaining that house, whatever house you're in, how does that affect your long-term financial health? So we're always thinking, again, right after the divorce is done, primary concern, cash flow, budgeting. How am I doing? Keeping everybody afloat, making sure that everyone is getting back into some sort of new kind of normal. Now is the right time for you to start to think about your long-term financial health and what is the real cost for you to maintain the house. So you can go through your old budget and you can itemize out the costs and and you can see that whether or not you have enough money coming in to pay for those costs. But would you be better off having less of an outflow to maintain the home and being able to direct some of that additional money into savings? Is that something that's going to help your long-term financial stability? Would it even maybe allow you to remain out of the workforce longer if you were the one receiving spousal support and you gave yourself so many years until you had to get back into the workforce? Maybe downsizing the house would allow you to continue to be out of the workforce for another year or two, to have that lower expense. One other thing to keep in mind is that when you have a lot of money in your home, in a way, you're putting the money to sleep in the house. So what I mean by that is when your house is going to appreciate, whether you have a mortgage or not, your house is going to appreciate. For a lot of my clients during the divorce, they just wanted to have everything paid off. But when we have $200,000 or $300,000 kind of put to sleep in the house, what that means is that you've lost the opportunity to invest it long-term for your future and plan for your own retirement. The house is going to appreciate regardless, but very small, in a very small way, except for right now when we're in a housing market in Michigan that is going like gangbusters. So now actually is a really good time to think about putting your house on the market, as long as you're thinking about downsizing. Because if you're thinking about putting your house on the market and buying something of similar worth of what you're in currently, you're probably you're gonna get top dollar, but you're gonna pay top dollar. So these are all things that working with a financial planner can help you analyze. And again, taking out those old projections and seeing, emotionally, am I ready to consider making a change that will help my finances?
Thank you, Jacki. So Jacki, touching initially on short-term cash flow, making the transition to long-term financial security. And a lot of times as financial professionals, when we think long-term, we think about retirement. We love to see our clients become financially independent. And with that, we also tend to think of IRAs, traditional IRAs and Roth IRAs. If you're not familiar with what that means, there's so many acronyms. IRA stands for Individual Retirement Account. And that's exactly what these are. They are investment accounts earmarked for retirement that are separate from an employer plan, such as a 401k or a 403b. So with the traditional IRA, for example, our first illustration here, typically you are able to deduct your contribution from income when that contribution is made, meaning you get the tax break now. But that is with the understanding that future withdrawals are taxable. A Roth IRA, on the other hand, does not provide any tax benefit now, but future withdrawals, as long as rules are followed, are tax-free. So as this slide illustrates for us, it's the balance of determining what makes the most sense for your situation. Does it make sense to take a deduction now and pay tax later? Or does it make sense to pay tax now and possibly enjoy those future tax-free withdrawals? And in that way, these accounts are a bit opposite from one another, but they do share a common feature, and that is tax-deferred growth. That means that there's no tax paid on these accounts while they are invested in hopefully growing for the future, for retirement income. With that said, however, there we go. Sorry for the delay. IRA and Roth IRA and traditional type employer retirement savings, they require earned income, and whether that's from full-time work or part-time work, and in the past, alimony and spousal support, when it was taxable to the recipient, counted as that earned income. For many of you on this call, you know that that's no longer the case. If your divorce was finalized after December 31st, 2018, alimony paid is no longer tax deductible for the payer, and it is no longer taxable to the recipient. So that essentially means if you have no income outside of the home, you're not employed outside of the home, if you're just receiving alimony or child support, you are not able to make an IRA or a Roth IRA contribution. That does not mean you can't save for retirement. So you may have lost the IRA or Roth IRA benefit, but there are different strategies you can use. And what we often do with clients is think of just a brokerage account, your typical investment account. However, these do not benefit from that same tax deferred growth. And that means that each year, the account holder is required to report and pay tax on any dividends, any interest, or any capital gains in that account. And although, you know, that can present challenges, that annual, you know, or that long-term tax deferral is lost. So there is a year-to-year tax drag. Jackie, are you able to switch the slide? It's not allowing me to.
There we go.
Okay, thank you. I'm so sorry. It just froze on my end, but yes, you don't get that long-term tax deferred growth. There's the tax drag year to year, which can present a challenge, but if you're working with a professional, hopefully they also view that as an opportunity, because we work with clients to make sure that your investments are appropriate for your situation. In some instances, that is using tax advantaged investments, such as municipal bonds or tax efficient ETFs, in some instances, annuities. But there are, of course, pros and cons to all of those strategies. Then, you know, no one size fits all again. But one, you know, item we find really is beneficial for most, and it seems counterintuitive, is tax loss harvesting. And what that entails is actually selling an investment when it's down. And that, you know, goes against that old adage, buy low, sell high. Why would you sell low? Well, that actually allows you to offset any other gains in the account. And what we do, there's a lot of, you know, rules involved with this. So I'm not recommending that you try this on your own. You sell the position when it's down, purchase something very similar. So in the off chance that there's a quick rebound in the market, you still participate in that upside, but can use the loss to offset income on your tax return. And, you know, we did a lot of tax loss harvesting last year. So spring of last year, when markets dropped so swiftly, we were able to take advantage of that from a tax perspective. Of course, reducing taxes, keeping them low, that's something everyone's thinking about. That makes sense, right? But in some instances, it can actually make sense to create income and take advantage of low income years because we have historically low tax brackets right now. And, sometimes with that, it involves actually realizing gains, selling investments to capture that gain before you need it. In other instances, we didn't touch on this on the last slide with IRAs and Roth IRAs, but you can actually convert money from that traditional IRA to the Roth IRA. And the cost of that is that you pay tax on the amount moved the year the movement occurs, the conversion occurs, but it stays within that tax deferred bucket. So you don't pay tax again. And as long as, again, some rules are followed, in theory, those withdrawals out of the Roth IRA in the future are tax-free. So you pay tax now when your income's low. That account can continue to grow tax deferred, and then in the future, possibly no tax due. So, we're really thinking about these things, especially now, creating income, creating tax, because, as I mentioned earlier, tax brackets are historically low. And there are some possible tax reform changes on the horizon. You've probably all heard that in the news. And we're keeping tabs on that to make sure that our clients don't have to think about it. We want to take as much off your plate as we can.
I just wanted to comment to Kali that I noticed and the current participants on this call, some actually have taxable alimony and some do not. So some people, again, that tax law changed. If your divorce was finalized by December 31st, 2018, then you have taxable alimony, which is going to but for some of you that still might be putting you in a lower income tax bracket. For those that do not have taxable alimony, so any case that was finalized after January 1st, 2019, your spousal support or alimony, even if you're receiving it, it does not count as income. So you would be theoretically in a pretty low bracket while you're receiving that.
Yes, thank you.
Definitely. Okay, there we go. A big issue that comes up a lot, if you were to pull out your old divorce decree, believe it or not, there are people that, I've been preparing QDROs since 2000. So for a long time, and we would get phone calls all the time from people that said that their divorce was 10 years old and they never got in 10 years plus, they never got the QDROs handled. I think for a lot of you on this call, I see that there are some people that are currently working with financial advisors at the center, and I know that you've got your QDROs all resolved or in the process of being resolved, but timing is really critical. One thing to keep in mind, when your divorce is done, it's one of those things, again, that is usually kind of left there hanging. When your divorce is done, a lot of times the attorneys will say to you, go ahead and get a QDRO, as the door is sort of like hitting you on the backside as you're walking out at the courthouse. And it's one of those things that you're probably emotionally at the time of the divorce, you're done with thinking about it. Timing is so critical because the divorce decree, even though it might give you rights to someone else's 401k or IRA account, even your regular brokerage account, sometimes people wait a very long time to get those transferred. Your judgment of divorce, remember, is only binding on you and your ex-spouse. It's not binding on third parties, such as the 401k account plan administrator, the account custodians, life insurance carriers. That's why you have to change your beneficiary designations. All of those things that say that they're going to happen in the settlement agreement, if you don't actually implement them, it doesn't matter. So if the plan participant, for example, were to die, remarry, or retire before the QDRO is the only thing that is going to get your qualified plan money, whether it's pension income or 401k assets, over to you. If your ex-spouse dies, remarries, or retires before that happens, you could end up getting nothing. So it's really, again, important. I always, tell clients that they really need to, the onus is on you. It only impacts you. And it's on your responsibility to make sure that the accounts get split, because at the end of the day, it's going to fall on you. And you can have the best written judgment of divorce that says all of the details about how the 401k is going to be divided. But if that person retires, or they move their money out, they roll it over to an IRA, they get remarried, they name a new spouse as beneficiary, the beneficiary designation is going to overrule your judgment of divorce, which is, again, only binding between the two of you. If you have QDROs already in process, or you've got something filed with the court already, whether it's been approved or not, you can breathe a sigh of relief that at least that part of it is done. Once it's been entered with the court, it's very unlikely that in the custodian's been put on notice that there's a QDRO pending. Whether they approve it or reject it, you can relax that you're going to be taken care of. One of the Department of Labor rules that was instituted a few years ago was that a QDRO couldn't be rejected on the basis that the participant had died. So you can actually enter a QDRO after the person has died. But again, timing, we want to get that done as soon as possible. As in terms of investment gains and losses too, if you're equalizing, I would say probably 9 out of 10 cases that I work on. So I work on about 40 divorce financial planning cases a year. About 9 out of 10 of those are they ended up the judgment saying that, or their agreement saying that these 6 or these 5 retirement accounts are to be equalized with the least amount of transfers. So if I asked all of you to raise your hand if you could, I bet that the majority of you would say that yes, in your settlement agreement it said that these following retirement accounts are to be equalized with the least amount of orders necessary. It can still be done after the fact, but when the accounts are not, if they're invested in different assets, then you're going to have some that are up and some that are down. And the more time goes by, the more complicated it becomes to equalize those. And again, we were always worried about beneficiary designations. If you're supposed to receive part of your spouse's IRA account, and they die before that gets accomplished, and they have another beneficiary, that's who it's going to go to. And then you're going to be stuck having to go into probate court, which is not ever an experience that I would want any client to have. After the QDRO has been approved, feel like, okay, we're all done. We can breathe a sigh of relief, put that away, lock it up in a closet. I don't have to think about it. It's still not done. So once the QDRO is finalized, a step that's often missed is that there is an interpretation letter sent out to the alternate payee and the participant. So this is true for pensions that are being divided and for the 401k type assets, especially for pensions that are being divided. Someone needs to look at that letter and make sure that their interpretation of what was in the QDRO is accurate. There are many times that I have gotten a call, 15 years down the line, somebody says, I'm starting to receive my pension. The survivor benefit that was awarded to my ex-spouse is higher than it was supposed to be. That's a mess to fix that out at that time. Every plan is required under ERISA. ERISA is the Employee Retirement Income Security Act. That is what governs the division of qualified plan money. Qualified plan meaning employer-sponsored plan, so not from the government. That's a different set of rules. Qualified plans are governed by ERISA. ERISA says the plan administrator for a QDRO has got to send an approval and interpretation letter. How many people ever look at that interpretation letter? Not very many. So the best person to look at the letter actually is an expert, someone like me, the QDRO preparer. Very often it's a step that gets overlooked. I highly recommend that you take out that interpretation letter that you have and make sure that you have an expert review it and make sure that it is correct. For those of you that are center clients already, that are working with a financial advisor, contact your financial advisor here at the center and have them send it to me to review and just to confirm that everything is fully taken care of. Once we have that in place and we know that the interpretation is correct, you're still not done, because you want to make sure that when it comes to the division of defined contribution plans, you have that one-time window to take money out of a qualified plan and avoid the 10% penalty if you are not 59 and a half years old, only with a QDRO, that you only have that option one time. So if, for those of you that are in that place where your QDRO has recently been approved and you've got the approval letter saying, how do you want the money? That's when you really need to pull in either your accountant and, or the most important really would be a financial advisor, someone to tell you how much money you should take out now. If you're going to need, if you have a gap, let's say that your spousal support is going to stop in 5 years, you have the ability now to take out money out of your 401k, from that QDRO, and avoid the 10% penalty. You want to make sure that you take out enough now so that you have money in 5 years if you're going to need to dip into it. But you don't want to take out too much because you want to balance that. You want to leave as much in retirement as you can to allow it to grow income tax deferred. So there's a very tricky line there that you need some, in my opinion, professional help helping you to make that decision. How much do you take out? Once you're done with that decision, for those of you that are receiving pension income from a former spouse, you want to make sure that you are collecting at the right time and that you're monitoring that. The plan administrator is not going to call you up and say, hey, Mary, it's time for you to start taking your pension, or you're eligible to take your pension benefits. How do you want them? Do you want to wait? For some people, it would be a good idea to wait. For others, it doesn't make any sense to wait at all, because that income that you're getting might not grow if you wait and hold off on taking it. So those decisions, again, as long as, that's why I said, take your QDRO out every year or so before you're ready, before you hit retirement date, to make sure if you're receiving pension income or you lost some of your pension, to make sure that that you're on track with the timing of that.
Yes, and so even if you're in the situation where everything's split, QDROs are done, it's still highly likely, if you've just let those accounts sit as is, that they are not allocated with your best interests in mind. So what is your timeline? What are your goals? Oftentimes we see accounts with one of two issues. Either the asset allocation is based on old goals, old timelines as a couple, or just strictly the preferences of an ex-spouse with no real rhyme or reason or strategy behind the allocation. And what this chart is illustrating is the absolute importance of your asset allocation, meaning your split between stocks, bonds, and cash. Research is suggesting that 90+% of your account performance is based on your allocation. Not timing the market, not finding the perfect stock or perfect investment. It's really finding an allocation that works for you and managing that allocation, sticking to that plan on an ongoing basis. The good news is, if you're in the situation where you're a year or so out from your divorce and you've let the account sit, you haven't made any changes, you've probably, experienced growth. So what's the motivation to make a change? Realistically, markets have ticked up over the last 18 months, even with the volatility we saw last spring, but we cannot assume that's going to continue indefinitely. If you're highly concentrated in stock positions and you're thinking, this account I may need to use in 5 years, it's time to take a look and reduce that risk. And the way we allocate accounts for clients, the way we decide what is the appropriate mix of stocks and bonds, is we say, okay, how much risk do you need to take to reach your goals? We don't want to take any more than that. And at that point, then we maintain that allocation for you and make sure that we're staying on top of those kinds of tax changes or policy changes that could affect your accounts. Essentially, our goal is to work in your best interests with your timeline, your ability to handle volatility. It's emotional as much as it is science, math. And having someone on your side to help you get to that point, make those decisions, and take that again off your plate is, I think, hard to put a dollar amount on the worth of that. So Jacki and I have, come to the end of our tips, our general thoughts, the areas that we really see clients kind of waffle or misstep. But we want to hear from you. As I mentioned earlier, so much of what we talked about is extremely personal, and we'll address those as much as possible. If we don't get to your question, absolutely we'll be following up with you and making sure we stay in touch. A few clients shared questions ahead of time, which thank you for that. We'll address those and hopefully give others a chance to think of your questions. If you raise your hand, we can unmute you and then ask your question. So the first question we received came from an attendee that says, now being single and currently earning more than ever before, I have concerns about paying exorbitant amounts of tax. Where can I shelter some money? I already max out my 401k. Also, being single with no kids, I have a ton of disposable income. First of all, congratulations. That's a great position to be in. You're already maxing out your 401k. That's the first place we look. So you're taking steps in the right direction. I'll say one place, people typically don't think to look at for long-term growth is an HSA or a health savings account. If you do have access to one, if you have a high deductible health plan, an HSA avoids income tax, avoids payroll tax, and it can be invested for the long term. And especially if you have an early retirement timeline in mind, we see that these are very useful in that retirement healthcare gap between when you retire and when Medicare kicks in. Any withdrawals from these accounts, if they're used for medical expenses, are tax-free. There is an added benefit that they can function like an IRA if you hit age 65. But all in all, these are really tax-advantaged accounts. And the contribution amount, the contribution limit is not as generous as the 401k. It's $3,550 a year for an individual, for a single person. But if you think about that, federal tax, if you're in the 24% bracket, still a reasonable bracket, you contribute $3,500, that's over $850 in federal tax saved. So not insignificant. So that's something to think about. Again, that is unique if you have access to that type of account. The second question we received is from an attendee who is currently using COBRA for health insurance coverage. It's going to expire soon, and they asked about, how do I budget for that, and how do I get coverage for myself? Typically, the first place we suggest looking is on the health insurance marketplace through the Affordable Care Act. With that said, depending on your situation, an off-marketplace or private insurance policy could be more appropriate for your situation. The reason we look to the marketplace first is because of the cost reduction benefits or subsidies that are available. Those, however, they're dependent on your income. So they're very sensitive to your income, and it is a cliff. So if your income, you don't have any flexibility, it's already over those thresholds, private policy might be better. But if you do obtain coverage through the Affordable Care Act marketplace, it's really important that you're mindful of those subsidy thresholds. And we work, very hard with clients to try and keep their income within those levels so they still receive those subsidies. And as I mentioned, they're very sensitive. It's a cliff. So if you're,
Hey,
sorry.
Can I ask you a quick question? So is that in terms of controlling their income? So you mean, how would somebody control their income?
Yeah, thank you. Great question. For example, we talked about the brokerage account. realizing capital gains, dividend interest, those things that you must report on your tax return. If we know you have a policy, an insurance policy through the Affordable Care Act, we need to be very sensitive of that, not purposefully creating any income, realizing losses as often as we can. So thank you. That's a good question. Looks like we've had a few.
We do have a few questions
Questions coming in. First question, does it